Let's be very clear about one thing. The market's primary product is noise. It's designed to overwhelm you with hype, with narratives, with endless distractions. Our job, right here, right now, is to cut through all of that and find the signal.
Today, that signal is a project called Fanable and its token, Collect. We're going to conduct a deep dive into the tech, the numbers, the risks, everything you need to know about its role in the new real-world asset landscape.
You have to understand, the entire game has changed. The macro trend has pivoted. It's not just about purely digital assets anymore. The new battleground for real alpha is the tokenization of real-world value. And you need to pay very close attention, because this is where the real wealth of the next cycle is going to be made. Okay, let's get into it. We're starting with the big picture, the real-world asset market itself. You have to understand the environment before you can analyze any player within it. And that brings us to the core question we need to answer today. We have Fanable, a project trying to grab a piece of the massive collectibles market. We're talking rare cards, comics, the whole 9 yards. So, is this a solid venture with real fundamentals? Or is it just another project riding the latest hype train? We're about to find out.
All right, Section 2. Let's drill down into Fanable's fundamental reason to exist. What specific problem are they claiming to solve? And, more importantly for us, is their solution actually investable?
The entire engine runs on one single concept, tokenization. Think of it as a bridge. You're taking a physical, often illiquid asset and creating a digital, liquid, and easily verifiable proof of its ownership. It sounds simple, right? But the devil is always in the details.
Now this is where it gets interesting. On the left, you see the old way of doing things. It's slow, it's inefficient, and it's plagued with risks around authenticity. On the right, you see the promise of Web3, instant liquidity, ownership that's proven by math on a blockchain, and entirely new ways to make money like collect to earn. This is Fanable's entire bet, that they can fix the fundamental problems of trust and speed that hold the old market back. Okay, time to pop the hood and look at the engine. We need to understand the tech stack, but more than that, we're on the hunt for the single point of failure. Because trust me, every single system has one.
So they chose the BNB Chain. This is a very calculated, strategic move. It's all about speed and low costs. They're trying to appeal to a mainstream audience that won't tolerate high gas fees. And the SocialFi integration, that's a pretty clever layer to build a community and reputation system. These are smart, tactical decisions aimed squarely at user adoption.
And here's the physical-to-digital bridge in action. It's a 3-step process. The real-world item shows up, it gets verified, and then locked away in a vault. Then, and only then, its digital twin, the NFT, is created on the blockchain. For this whole system to work, this process has to be absolutely airtight. And there it is. We found it. The single point of failure. The entire multi-million-dollar value of all these digital tokens is backed by physical items sitting in one centralized, real-world location. This introduces a massive dependency. You've got operational risk, security risk, you name it. This is the project's Achilles heel. Any serious analysis has to start with the fact that you are trusting a third party to guard the actual asset. We've now arrived at the most critical part of this entire analysis, the tokenomics. The tech can be flawless, the team can be brilliant, but bad tokenomics will kill a project every single time. This is the part most people skip. We don't. First up, the max supply, 3 billion tokens. Now, a big number like this on its own doesn't mean much. It's usually just a psychological trick to keep the price per token looking low for retail. What really matters is how many of these tokens are actually out there and how quickly the rest are coming. And here is the number that should have your undivided attention, only 18%. Out of 3 billion total tokens, less than a fifth are actually circulating. You have to understand what this means. This is an extremely low float. This one number dictates the entire game for every single person holding this token. Now, look at this chart. That huge 82% slice, that's not potential value. That's potential sell pressure. It represents all the locked tokens for the team, for early investors, for the ecosystem. All of it is sitting on a timer, waiting to be unlocked and potentially sold into the market. This is a supply overhang that will be a factor for years. So let me be absolutely clear. A low float like this is not a feature. It is a future inflation liability. Sure, it makes it easier for the price to pump hard on low volume in the short term, but that's the trap. It's a ticking time bomb of inflation. And this is exactly how the venture capitalists and other early investors plan their exit. They need the price to be high when their tokens unlock so they can sell.
And they've got 11.5 million reasons to want that price high. This is how much smart money is already at the table. And let's remember, these funds aren't charities. They have partners they have to answer to, and they are expecting a massive return on this investment, a return they will get by selling their vesting tokens. Your job is not to be on the other side of that trade.
Any project is only as good as the people running it and the capital backing it. So let's take a look at who's actually steering this ship.
Okay, there are some serious names here. Sfermion is a heavy hitter in the NFT space. And those partnerships with grading companies, absolutely essential to build trust. But look at that last point, continuous transparency reports. What does that tell you? It tells you that even the insiders, the people who wrote the checks, understand the centralization risk, and they are demanding constant proof that the assets are secure. Trust but verify.
So we've analyzed the thesis, we've stress-tested the tech, we've uncovered the risks, and we've run the numbers. Now it's time to put it all together into a final verdict. This table lays it all bare. The strengths are obvious, a huge market to capture and very strong backers. But the weaknesses are severe. That token inflation is a mathematical certainty, and the physical storage risk is a constant threat. The opportunity to bring millions of new users into Web3 is real, but so is the threat from regulators or a giant like eBay waking up and deciding to do this themselves. This is a classic high-risk, high-reward play. So here's the bottom line. Fanable has a credible chance to disrupt a multi-billion-dollar industry. The potential is absolutely there. But the tokenomics present a major headwind, and the entire model has a critical, centralized point of failure. This is, by definition, a speculative asset. Look, we don't give buy or sell calls here. That's noise. We provide analysis. We provide the signal. The final decision is and must always be yours. Look at the data we've just gone over. Understand the risks we've identified, and then ask yourself the only question that matters. Does an asset with this specific risk-reward profile belong in your strategy?